All right. What is going on, everybody? And welcome. My name is Chris, no risk, no premium in the Discord. And I got my good longtime friend Deion with me.
Yes,
Deion, what's
sir.
going on, brother?
How's it going? Thank you for having me. Let's go. What's up, Wolves?
Yeah,
What's
what's
good?
going on, guys? So today is a very special edition. The first of many, what we are anticipating to be educational slash free game to y'all to put on for the Wolfpack. Deion is a very good friend of mine. He's also a very successful tax planning and strategist. Has a consulting firm, but we'll get all into that. But guys, most importantly, he's a fellow wolf.
Yeah.
You know what I mean? And so I thought it was really cool what Dion did was, he actually reached out to me, and he was super inspired by all the gains going on. He was seeing, just a lots of success. He understands the culture, and so he reached out to me. We sat down. He's like, bro, he's like, let me get in front of them, for free, guys. He's not asking for anything. This is free. This is he wants to come out and
Yeah.
put this out to y'all. So Dion, we appreciate it, man, a lot. Thank you. Um, many drinks, many phone calls
Yeah.
have been consumed and done to get to this level. So yeah, man, we just super appreciate to have you.
Yeah. Thank
Have you
you.
be a part of the Wolfpack too, man. Seriously.
Yeah, thank you for having me. I love the community, what everybody's doing, how interactive everyone is, and I'm just here to spread the knowledge I have. I hope that the others, do the same. It just starts a
Yeah.
trend of, us. That's the new currency, really. Though outside, is knowledge. That's gonna really
Yeah.
push us to that next level.
Yeah.
So the more
No,
we
that's
can
it, man.
keep encouraging that and motivating each other, I love it
Yep.
though. Yeah, and I'm just here
No,
to
you're right.
drop a few gems that maybe people know. If they don't, if I could help them 1%, I feel accomplished, you know what I mean, to help
Definitely.
you reach your goal. So let's get that done, and I'm
Yeah.
excited to get this going.
Yeah, no, I'm excited too. So we'll definitely, man. You're right. That currency though is it's not what you know, it's who you know. Because if
Who
you don't
you
know
know
something, you need to know somebody that does. So
that does exactly.
so that's more valuable than anything else. So all right, brother, let's
Let's
sorry,
get
getting a couple
into it.
people in here. Let's get right into it, guys. So hey,
Yes, sir.
just so you guys know, man, we'll do a quick introduction for Dion here. But Dion, I've known him for what? I mean, years and years and years, bro. I mean,
Yeah.
we competed against each other playing basketball, super high levels for a long time. Then we ended up going to the same high school, and we played together all 4 years. We're a part of some very successful teams. We competed at a very high level together, and then after that, man. I mean, Dion, go ahead. I'll let you explain, man. You guys got the introduction here on the screen. You went off and went down to beautiful San Diego, bro. Tell me about that.
Yeah, so yeah, like you said, yeah, we go way back, but yeah, we competed in basketball, competed on the same team, and that
Mhm.
same mindset led me into getting into San Diego State, where I knew I wanted to get into business. I just wanted, the most value that I thought at the time. The hardest major at the time, I got into accountancy.
Mm.
Graduated in 4 years. Had to do a fifth year so that I could, um, get my CPA. That's the requirement, 150 units. So
Yeah.
about a year and a half after
So
graduating.
it's a full nother year after. You got to do a whole nother year
Yeah,
after that
yeah.
that
So
regular four.
exactly. So with that year, I got a minor in entrepreneurship. They have a good entrepreneurship program. So my mind was
Definitely.
always on that entrepreneurial mindset. So I was
Yeah.
just trying to figure it out while I went. But
Hmm.
I knew I wanted to get that CPA because it's something to fall back on and something that I could use going forward in the business world to legitimize myself. So
Yeah.
I went and
I know
got that.
that's not easy to get either.
No, no,
That
it's
CPA.
it's it's
That's a hell of an
four.
exam. Well, it's
Yeah,
four exams.
it's four exams. You study about three, at least. They suggest about 3 months of studying. It's comparable to the bar. I think that's the only professional test that's comparable. So
Yeah,
about
to
that.
be to get your CPA, I know that is not an easy task.
Yeah,
And it's not a job for everybody. So, kudos to that.
yeah.
Um, and then, bro, what happened after that? Where'd you go?
So then I dabbled into the corporate world where I did you know accounting for small businesses, and there I learned about flow through entities, how the owners of these businesses are flowing their income into their personal tax returns, what they're writing off, how they're getting through the tax code. Started learning that. But then my real passion was always and kind of real estate. I knew I wanted to get into real estate at some point. So I moved out to LA. I had an opportunity to get a position doing real estate taxes. So that's what really opened me up into the real estate world, seeing the backdrop, seeing what's going on in real estate, and learning about the investment world there. And from there, I started my entrepreneurship through accounting, where I started bookkeeping. With that, it kind of tumbleweeded. People are like, "Oh, you're doing my books. Can you do taxes too?" And I'm like, "I can. I'll do it. Let me
Yeah.
tack it on." And then I started tacking on more things. Then I started getting more clients. People, I'd post things
Getting
that
referrals.
people are asking. Yeah,
Yeah. Word of
exactly.
mouth. Yeah.
So
Yeah.
it started tumbleweeding. I got a index of clients. Then 2020 came, and I'm like, okay, I'm at a
Shit hits the
standstill. Yeah,
fan.
yeah, yeah. Shit is
the
getting
world
crazy.
the world catches on fire,
Yeah.
right?
So I'm
And
like,
you
fuck.
had
All right.
you had just for clarity, you were working the corporate side, right? Then you
Yeah,
had started the consulting practice, and then you had left
yeah,
the
yeah,
corporate world, and you were
yeah,
just full time. And then
yeah,
2020 hit because I remember us having a conversation. I think we actually met up and sat down, and you were just telling me about what was going on, and you were like, we were all kind of like, what the fuck's gonna, what the hell is happening?
yeah,
But dude, there wasn't a sound of fright or hesitation. Tell me
yeah,
about what you did next, because I
yeah.
mean, it was pretty cool to see the transition you made and how it seems to be that you doubled down on what you were doing and
Yeah,
created
definitely.
a huge separation from your
Yeah.
competition. So tell me about the
Ye-
2020 time.
So yeah, I was doing my consulting practice, but I wanted at 2020, I'm like, shit, you can't depend on one thing at this time. Like you
Hmm.
don't know what's gonna happen. So let me add a craft. Let me become more of a resource to the people I know. I had a passion for real estate, so I'm like out on the market trying to figure out how I could get a foot into real estate.
Hmm.
I stumbled upon a guy named Idan Amar, who's my partner now. At the
Yeah.
time, he was looking just for assistant, but when we connected, I'm like, this guy was sharp. He knew what he was doing. He was a CPA as well, so we kind of met minds on first touch, and then from
Yeah.
there, he brought me in, and I kind of told him I don't want to really assist you. I want to be under your wing and learn. So
Like an
from there, I'm
apprentice.
like, yeah, exactly. It was more of an
Yeah. Okay.
apprenticeship. And I'm like, honestly, you don't have to pay me at all. Like I'm good right now. I have stuff going. But if you could get my trajectory on the real estate game up, that much quicker, let me do that for free. And then we'll figure it out, monetarily from there. So that was
Yeah.
how I got into my passion for real estate. Now I'm using real estate and my accounting, using it together to be a resource. So when I'm talking to real estate clients, I throw accounting tips and knowledge
Yeah.
to them and vice versa. So
You
it's
just
been
cross
really
selling at
good.
that point.
Yeah, yeah, it's
Yeah.
been really
Yeah.
good.
Yeah.
And I just plan on adding to that. And just
Uh-huh.
being a resource to everyone like I'm doing, hoping to do for the wolves today.
No, for sure. I think that's awesome, bro. I mean, you work for free. You tell me you work for free. You said I'm gonna
Yeah,
work for you for free. But
yeah,
a lot of these people probably don't know. Dion is in the LA real estate market. The broker he works for, Don, or the
yeah.
the broker he works underneath, the Don, is very successful,
Very
very
successful.
very very well known in the area. And I think you were telling me what you guys did about. So they do luxury homes. You guys did about 30 mil
30
in
million.
sales.
Yeah,
Yeah.
yeah. We're
So,
closing in
you
on
gave up
30 million.
a lot of free working time to obtain the connections, the networks, the information. And now what? You guys are doing 30 mil,
Man,
30
yeah,
mil since you came on.
yeah,
So, I mean, that's insane, bro. I mean, congrats. That's
yeah,
awesome.
yeah. And I
For
just,
real.
just hope to keep climbing from there.
Yeah. No, no
But
doubt. So
but
then,
yeah,
okay, then tell me. So you got your CPA. You
yeah.
obviously went out and got your real estate license, but what'd you get first?
So I
What'd you get
actually
before that?
before that I went and got my mortgage loan originator license, which allows me to broker mortgages just to
Mm,
learn more about the financing of the real estate. I wanted to dive all the way into it and know as much as I can. So I went and got that. That was quicker. I was able to get that in about 2.5 months. So I could
yeah.
also do that. Eventually, I want to have an all in-house, operation going on where
Yeah.
somebody could come in and do it all, you know. So
A
that's
piece of
my
every pie.
mindset. Exactly. So that's where I'm trying to start that now. So I went and got that, and I got
Cool.
my, agent's license, and now I'm here just trying to make it all work and put it together and help wherever I can.
Yeah, definitely. Um, cool, man. So hey, we'll jump right into
Yeah, let's start with some
uh
tax stuff.
yeah, we'll jump right into it. So guys, that's Dion's background. Very well versed, amazing background. Um, so we'll jump right in. Let's talk about a little bit about how you can break down your tax code and best make it work for you. But first we need to understand, hey, how the money comes in, right? Dion, you want to take it from here?
So wolves, I want you guys to understand your income is going to be taxed in two different buckets, right? You have this bucket on your left, the active income, or your active income, and the STCG, that's your short-term capital gain. So your active income, that's going to be if you're a W-2 worker, this is the federal tax bracket that you'll be using to determine your tax rate. And if you're doing so, this is for your day trading people that are selling, within investments within a year, they're going to fall into this same bucket of active income. And as you can see, this tax bracket hits 37%, and that's just on the federal side. So if you live in high tax states as well, you have to tack on that state rate. So you could be, if you're in California, you're at 50% if you're at
Yeah,
that
I was
highest
gonna
tax
say,
rate,
i.e. California.
Yeah,
Yeah.
yeah,
New
exactly.
York.
So,
Yeah, I mean,
so
yeah.
exactly. And then we're gonna look at that long-term capital gain chart here on the right, which is going to be investments held over a year. So over a year, you see that the max rate is going to be 20%. Um, so
So
as a
you're telling
tax
me this.
consultant, yeah,
Yeah, so you're telling me this. So on the left is what you would make actively, as far as like giving up time, exchanging your time for money. So i.e.
yeah,
jobs that you work actively, you get W-2.
yeah,
Those long-term investments like a dividend portfolio,
yeah.
like staking crypto, owning investment properties, real estate will be on the right side of the screen, and it'll be a long-term capitalized. And the max you'll pay in taxes is 20%. That's what you're telling me.
20% for that. So if you're in that 37%, basically that 37%, instead, if you turn that over to long-term capital gains, you only pay 20%. So I kind of advise, or preach, either if it's going to be active or short-term capital gains, let's minimize that as much as we can if we're going to tack that onto this year. Or if not, let's find a way to move it to a long-term move, so it's only going to get taxed at 20%. So that's
Yeah,
how we're going to have to think, strategizing.
yeah.
Are we going to minimize this active income short-term capital gains, and we'll go into how we can do that? Or are we going to just passively let this grow and then get taxed at max 20%? So
I feel that.
yeah, we can
No,
dive
for
into.
sure. Yeah. So to me, I'll just give a little bit of my thoughts on it. So it seems like you want to do everything in your power to move from having all your money to flow through on this side. You want to move it and have it come through on this side if possible. And
If possible.
I'm if possible. So that's why it's super important to start investing your money long term as early as possible. Would you agree?
Yeah, exactly. Or
Yeah. Would you?
amplifying your money to where you can one day put it into real estate or something, a vehicle that you could let it sit and build over time, and it's less work, and you're still getting that appreciation on whatever your investment is, at the same time not worrying about having to pay 37%, because all of us
Yeah.
want to be at the top tax bracket, right? That's
Oh
why we're
yeah,
here.
yeah.
That's why
Well,
we're
I've
here.
got, California is 37%, then we got to add on 15, and they want to
15,
make it 18 now,
18, yeah,
right?
yeah,
So
exactly. Like, what are we bringing home? There's no meat on the
yeah,
bone. Like,
yeah.
yeah, what
You
are we?
take if they're taking more than 50% in total,
So,
I'm getting the short end of the stick there.
yeah,
Like I
exactly.
can't.
That's not
So
an option, really. Like, none of my clients, that's not an option. Like,
yeah,
never.
yeah. So that's why I'd say the rich people, you can be rich, and pay a lot of taxes, or you could be wealthy, and you're going to be on
And
the right side.
understand.
You're going to
Yeah,
be over there.
exactly.
Yeah.
Exactly.
hmm Yeah, you can
Exactly.
make a lot of money
You
actively,
you
or
can
you can
make
make it a
six
lot.
figures, but they'll take
Yeah,
50.
a lot of
You
it. Yeah. It only takes what? I think it takes 400,000 to be in the top 1%.
Yeah.
Individual income. That's not a lot.
That's not,
I mean,
no,
you know what I mean?
not for, I feel like where our wolves mindsets are.
Not for the people in our group. No,
Yeah,
I agree. I agree.
exactly, and that's the difference, though. That's why we're here today.
No, definitely. Okay. So
Yeah.
now
So
we'll move on here, but yeah, that's good. So guys, it's good to understand. Hey, there's a difference between short term and long term. Okay, we
yeah,
all want to shift and try to have as much money as possible to flow into the long term.
long
That's what
term,
wealthy people do.
or
All right,
minimize these. Yeah, active.
or
Yeah,
minimize the active income.
yeah, yep.
Yep.
So yeah, like I said, you're able to kind of determine how your income is recognized, especially for wolves that are day traders. There we'll go over ways that you could, let the IRS know this is what I do for my everyday line of business, or this is something I do passively, and the income will be recognized different, and you'll be able to write things off different, and we'll go over that. Or
Hmm.
for example, like how integral are you to operations of the business? If there's a way you could step back and just kind of be, have money in, but without getting your feet wet, that's considered a passive activity. But if you're
Yeah,
in there doing the day-to-day activities, making key decisions, you're going to be thrown into that
in the
active.
active. So
Yeah.
you could like, for example, you could be like you can be a CEO of a company and
Hmm.
still work every day for a salary, but you could own a company and have a
Exactly.
CEO in place, and now
You're
your stake in the
passively.
company is passive, being
Exactly.
hands off. That makes
Exactly.
sense.
And
Okay.
and and technically in the IRS it says that any trade or business that you do less than 750 hours is considered passive. So I think that's on average 15 hours a week.
Yep.
So that's just for, yeah, peace of mind.
Yeah.
It's what
So
they look at it.
for example, like Jeff Bezos of Amazon. Now, no, I don't think any of the wolves we own any. We don't own Amazon. But for example, a lot of people are like, "Hey, why did he retire?" And it's like, he started and owns Amazon, but he was also the CEO, right?
Yeah, yep,
So that
exactly.
there's the example, right? He steps down, hires a new CEO, and now he's all back end. So he's now his business is all recognized as
As
passive.
passive,
Is that
yeah.
right?
Exactly. So he's just kind
That
of
makes
putting it
sense.
in a different bucket. Exactly. And
Okay, gotcha.
that's at a higher scale, but yes, yeah, definitely.
Yeah.
He's
Hopefully we
positioned
could all get to
he's positioning it,
owning
yeah,
Amazon.
he's strategically positioning himself where, yeah, he's telling the IRS, I'm done, right? I'm not like, I'm done with this. Like, I'm not doing anything.
Yeah.
I
No,
still
for
know
real.
it's doing well, but yeah, don't
And
tax me
it probably
like
helps.
I'm
He's still probably got, I mean, hundreds of thousands, if not millions, of shares of Amazon. I mean,
done.
that doesn't hurt. That
Exactly,
doesn't hurt.
exactly.
Yeah,
So
yeah.
yeah, that's along the line. So yeah, I want to
Okay,
go
cool.
into, the first way we could deduct, you know, our
Oh,
losses, deduct them
yeah.
going forward.
Yeah. So this is an important one. And I'll make the transition here. And I thought this was an important slide for us to throw in because listen, we don't want to lose money. And that's what a capital loss carryover, um, tax loss carry forward will also be what it's called. But I would say an overwhelming amount of people that we've seen in our group, that have come from other groups or have just come from trying to invest and trade on their own. And I'd say a very overwhelming amount of the stories start like this. Um, they start with, wait, shit, sorry about that. They start by telling us, "Oh my God, I was in another group. I was trying to do it on my own. I was doing this, and like I've lost an account. I've lost thousands and thousands of dollars." One example. We have one guy who lost like 24,000 on the year.
Mhm.
Since he's come back and been with us for the last month, he's now recovered all of those losses, right? But sometimes there's an advantage to actually losing some money long term, although we don't want to lose it long term, but in the short term, taking the loss. Talk to me a little bit about the tax loss carry forward.
So yeah, like you said, yeah, the taxes allow you, if you do it right strategically, use the bad things that happen that seems bad, to your benefit at some point.
Mm-hmm.
You know what I mean? So with the capital loss carryover, this is more for someone that has a W-2 job or has he's bringing in income from a more day-to-day job but does
Mm-hmm.
trade, more passively. So say this is for someone that say their first year, they don't know much about trading. They have a lot of capital they put in. Say they take a $30,000 loss on their first year, at the year close. This capital loss carryover is gonna, okay, this next year, say, okay, I'm learning how the market works. This is my hot year. Let me go get, like you said, 24,000 in gains. Okay, you only got 24,000 in gains. That year of the 30,000, the initial year that you lost, oh, you didn't have any gains to offset. So all you have on your books are this 30,000 short-term capital gains. We're going to use short-term.
Yep.
So that 30,000, you could take, the IRS allows you to take 3,000. So now it's in a pot. It allows you to take 3,000 out of that pot, and say your W-2 job, your W-2 wages are 100,000, whatever it may be. It allows you to take 3,000 from that 100,000 of ordinary income, W-2 income, whatever income you're getting, and deduct it from whatever you're getting in this other box. So you would have 27,000 after that remaining going forward until it's exhausted. So
you're telling me that basically, I want to mute some people real quick. So basically, let's say you lost 10,000 or the 30,000, right?
Yeah.
So you would be able to hold that as like an account or a pot, like you said, and every year for the next 10 years, you could deduct $3,000 every single year until that's exhausted.
If you had to, but say the next year you had 24,000. So say that after that first year you took the 3,000, right, against your ordinary income. So now that pot has 27,000 in there, right?
Yep.
Say the next year you come and it's a good you have gains of what? Let's say 24,000. Okay. You could deduct. You could still use that pot, that 27,000. Cancel out that 24,000 of capital gains. And use the excess to that 3,000 against ordinary income. So so you have to know, okay, this loss is like, let's use this beneficially, going forward. Like make that your last bad year and go forward. And you know what I mean? It's like that has to be in my, okay, I fucked up this time. Let me go forward and make it up strategically, where actually, it's not too bad, really, right?
Yeah,
as long as you don't keep that cycle. So that's a key thing in this capital loss carryover. A lot of people don't understand that. And when you're doing using like TurboTax and things like that, they're not always gonna automatically apply these. So it's important to understand, like when you do have an accountant or a consultant, they understand what your strategy is to build wealth and how you're doing it, and can properly adjust what you're doing tax wise during the year, so that at the end of the year you're in a position to pay the most minimum tax that you can.
Gotcha. Okay. Yeah, I follow you. No, that's good. That's good. So guys, think about it like a pot. You can deduct the amount that you lost until the pot is gone. So although sometimes we take some big losses and we follow some big trades, or we go against our rules, whatever that happens, hopefully for the year you're not red. But with everything bad comes some good. So I thought that was an important thing for us to hit on there for a sec. So well said.
Very important.
But with TurboTax, it should come on the brokerage, so from your brokerage or from the W-2 on your brokerage account. Or you get the W-4. No, what is that called from you get a W-2 from your brokerage store, whatever that form's called.
Yeah, you get a 1099 usually.
Or
it's a 1099. Yeah.
It comes from the actual brokerage.
And
you're able to
1099. Yeah.
Yep. Okay. Cool.
So that's what you'll see that. But then when you have that bucket of losses, I mean, like going forward, it's not always gonna, like, say you use TurboTax 1 year, it's not always gonna, you need somebody to know that you have carry losses from prior years.
You still have it from applied. 2 years ago, 3 years ago.
That need to be applied. Yeah. Correct.
Gotcha. Okay, cool. All right. Well, that was the first thing I thought we'd hit on. So the second thing we can get into, this is a little bit more day trading focus, would you say?
I would say that this one is, I would mark to market accounting. This is for are active traders. So I mean,
Hmm.
when I say active traders, I mean this is the traders who do this day to day. This is their bread and butter. This is their money maker. This is their profession, basically. You know what I
Hmm.
mean? So this is kind of opposite of the last scenario I said, where it's kind of more passive. This is would be, the active part of trading. So
Hmm.
you have to qualify for trader tax status, and if you guys want more information as to what that all entails, I could give you that. It's mostly based off volume,
It's off the
frequency.
volume of trades you make
Yeah,
for the year. You have
volume,
to qualify.
frequency,
Yeah.
exactly.
Hmm.
So you
Yeah.
have
Yeah.
to just show that. So it's based off that. So basically,
Proving you do it every day, and
exactly,
it's your only income, or it's your main source of income. So yeah,
exactly,
gotcha.
exactly. So it allows gains and loss from all securities, as you can see, or commodities held in connection with your trading or business to be treated as ordinary income instead of
Hmm.
capital. So instead of having to use those losses against capital gains only, and then only having 3,000, when you elect to do mark to market, that's going to be looked at as your income on your 1040. So it's going to flow through as your basically, along with your schedule C income, all that other income, it's all grouped together, and it's going to flow into your 1040 like that.
Yeah,
So
gotcha.
so then from there, you have to make an election with the IRS, and then elect to have a change of accounting through them, and then from there you're able to report your gains and loss as your active income. It'll
Hmm.
be on a schedule. It's called Schedule 1, instead of your capital gains, which go on your Schedule D. You'll see it on your 1040, and then that will lead to, then we're in that short term bucket now we're playing in that short term bucket, right? So like
Hmm.
I said, when we're in that short term bucket, you want to start trying to minimize things, minimize that short term. Then I think that's what we could go into as well. But does that make sense with the mark to market?
Yeah, so it's basically more so what I'm understanding is for anyone that's more actively trading as their full time role. If you have a
Yeah.
W-2 job, where you make your significant amount of money from that actively, then this is not going to really apply to you.
No,
Yeah,
no. So yeah, I just wanted to, you know, let both sides know,
of
whatever
course.
wherever you're
Yeah,
in on the spectrum, that
yeah,
there is a way to
hmm,
minimize or use the tax code, at least,
yeah,
to your advantage, or by knowing what's going on. That's
definitely.
that's it.
I'd say about 80% of the people in our group probably have a full time job, and trade on the side in addition, which is pretty impressive when you
That
see
is
the amount of
exactly. I
successes
mean,
that we
that's
have.
even
But
better.
I'd say
Yeah.
about 20% of us probably fall under this. And so the 475 F1, that you can just elect that, to the IRS when you're filling out your taxes, correct?
So yeah. So like coming into so it's too late to make the election for 2021 year. So as long as
Okay.
you do it prior to, I
The
believe
year
this
end.
year is I believe this year it's March, before April 15th.
Okay.
So you could, for your 2022 year, if you make the election prior to April 15th this year, everything on this year, all your trading for 2022 will be recognized as mark to market.
It's mark to market. Okay,
Yeah, as
gotcha,
long as
gotcha,
you could
gotcha,
substantiate that you have that trader tax status, you know what I mean?
gotcha, gotcha, gotcha.
Yeah.
Um, Okay. There's a question that Tisha has.
Yes.
Um, we'll answer it. We'll get to these questions at the end, guys. We'll just want to flow through, and then we'll do a little Q&A at the end. Does that sound all right? But that's a good question, Tisha. So okay, we'll move forward here though. This is the bread and butter. This is the reason why we brought you on. Everybody wants to know, man, what can we write off? You want to go ahead and just take it from here?
Yeah, let's go into this. So writing off, yeah, this is big. Especially if you're using that mark to market, it's definitely something that you would want to use, because the more you write off. So when you're using that mark to market, then you have your standard deduction and you have your itemized deductions, right? So the standard
Hmm.
deduction is, I think it's 12,550,000. But if you have write-offs that surpass that 12,550, you're going to want to use those itemized deduction, because that's going
Hmm.
to give you, that's
A
going to,
higher
yeah,
deduction
that's
amount.
to deduct your income. So
Yeah.
when we're going into that, so that's what we have to understand. So now you have your income, your tax return runs like that, right? You
Hmm.
have your income, um, and now you have your income. Now let's minimize it. After you have your income on the top, you have your deductions. Then you're gonna have your tax liability based off what's your net income, right? So now
Gotcha.
you're going into self-employment tax. Like, okay, now if you're an active trader, you're basically self-employed. The government makes, at that point, everyone has to pay this self-employment tax. Like if you're, it's if you're gonna be a part of a business, own a business, working for a business, everyone pays this FICA taxes, Medicare and Social Security.
Yeah, Medicare, Social Security, it's a
Security, yeah,
minimum. You have to
yeah,
you
you
have to
have,
pay it.
yeah. It's just
Hmm.
being here.
Required
So
by law. Yeah.
so there's two sides of that, an employer and a employee portion that's matched. So as a self-employment, you'll be able to deduct that employer amount from your
Hmm.
taxes. So that would already start. Say you do
Okay.
your say you do your trading in a room in your house, right?
Yeah.
You could do that. Home office, you use that. Internet and
Okay.
phone bills. Say, yeah, okay, I'm at home. I'm on the phones too,
Yeah.
making calls, doing things, whatever it may be. If you could substantiate that you're using it to better what you're doing as a business, or to make money or to stimulate the economy, that's what they want to see.
Okay.
And you're able to write it off. Things like health insurance, meals, travel. Say you're going to a convention, a trading convention. I don't know, whatever it may be. If you have a reason why you're meeting up with, wolves, where we're going to talk strategy, and you can substantiate it. Okay, we went there. The thing is, now we have technology too, so you could
Mm.
record things. Hey, I'm with my wolves eating, talking
You
about,
document it.
yeah.
Yeah.
If it's documented, what are they gonna say?
Okay.
You were not doing that. Okay, yeah, that's what we came to do. We did that, and we're showing you what we
Okay.
did.
So let's use someone like me, for example.
Hmm.
Full-time trader, right? Um, let's use someone like me. So we talk about deductions that I'll be able to make. So let's say someone like me owns or rents a home and I use my home office. I can write off a percentage of the square foot of whatever the rent or mortgage payment. Some people rent, some people own,
Correct.
right? Okay.
Correct.
Then I also have to buy a laptop. I need computer monitors. I need a microphone. Um, I need um, I need a mouse. I need all the hardware. I can write all that off.
Correct. Yeah,
All
all of
righty.
that.
So that four
All of it.
thousand dollar laptop I just bought, I can write off.
Correct. Exactly. Exactly.
Okay.
That like, because what's going to happen is every year you can elect to use the standard deduction or the itemized deduction. So
Yeah.
say you
Hmm.
run up 20,000 in deductions this year, you're going to
Yeah.
use that itemized deduction because you're getting almost 8,000 more.
More. Yeah. Yeah. Yeah.
So that's just another way of deducting.
So
You
then,
know,
okay, we'll take it a step further then. So let's say some people are on I use my phone to check my brokerage account. I use it to go on Zoom calls like these that are bettering my understanding of the tax code, better understanding for my job, for what I do. Would I be able to write off like my phone bill, my
phone
internet
bill.
bill that I need to
Yeah.
access this? Okay.
Exactly. Yeah. I mean, it's necessary for you to run whatever you're doing to
Hmm.
whatever you're calling your business, basically. And that's what, when you
Yeah.
make that election, you're telling the IRS, this is my business, right? This is what I
Hmm.
do. So I need to invest into myself to, stimulate the economy, do things to make money. So without doing this stuff, yeah, how am I supposed to make money and pay you taxes? So it's like
Exactly.
it works hand in hand. Yeah, you write things off, but they expect, okay, you're doing all this, okay, you're gonna make some money out of it. Let's
Yeah.
let's trade off. You know what I mean?
So, okay, we'll take it a step further then. So let's say every Friday I go out and I meet up with some of the members and we trade live,
Yeah.
like a lot of members we did yesterday. So you're telling me that if I had to put gas in my car before I drove out to LA, 45 miles, I could write that off.
So yeah, the IRS allows a deduction for mileage. I believe that the mileage reimbursement is 62 cents a mile. I don't know how that equates in these with these tax prices, but yeah, depending on your car, yeah, you could log the miles it takes, whatever that
Yeah.
travel is.
Hmm.
You have that. There's apps too. There's a lot of apps. Okay,
Yeah. Yeah.
let
To
me
track
let me
it.
track my miles. Okay, then you have, oh, we recorded it on Zoom that we were trading here. All right, that's documented. You
Documented.
trade it
Yeah.
back. Everything's clean. I don't see why they wouldn't be able to. You're
To prove you're wrong.
substantiating everything that you're doing, and it's within your line of business.
Definitely.
Hmm.
No, for sure. So let's say now, in the same example, I'm out trading, and Trail put on a performance for everybody to trade SPY. Everyone made a ton of money. So I want
Yeah.
to treat Trail to breakfast, but I also want to give myself something to eat. Would that meal be something that could deduct because we're sitting there talking business after the fact while
Well,
trading?
definitely. Especially with as him being a wolf, it's like, oh, we're literally in lieu with each other. Like
Yeah, we're working
we
together right now.
yeah, we're working together. What
Okay,
I'm treating him, and we're talking business. What we're here to do is talk business. What we've done, what we can do. I
okay.
mean, as long as you don't abuse it, like
Yeah.
everything is clear as long as it's documented. Now
It's
I'm
not as
just saying,
every meal I
yeah,
eat is
yeah,
a
yeah,
business
yeah.
meal.
It's like, okay, yeah. Like, are
They're
you
gonna be
dating
like,
this dude? Yeah, yeah.
who
You
are you
dating?
talking to at McDonald's drive-through about the like? Oh, I was telling the guy
Yeah,
about the wolves. No,
yeah.
I get it. I get it. You want
Exactly.
to, use it enough for when it's legitimate, not, not abuse it. So now, we got a lot of members in the group, including myself. We use a lot of subscription-based services like to help better our trading. So think of things like a Tradelytics, Unusual Whales. You could use Trade the News, Benzinga Pro, Walter Bloomberg News Terminal. Our group, the Wolves of Wealth group, with this
Yeah.
subscription-based service
Hmm.
with education. Are all of these things that would help you become a better trader things that you can write off as well?
Yeah. It's like it's kind of considered like investment counsel and advice, kind of, right?
Gotcha.
Like that's how I think you would call it. You would call it like, okay, subscription. They're kind of helping me, up my business, increase what I'm doing, optimize what I'm doing, right? So
Hmm.
you could substantiate like that's the only reason you're in there. You're not just spending money, and it's not just for your shits and gigs. You know what I mean?
No, yeah.
You're doing this so that you could drive the economy up. That's what the tax code is about.
Gotcha. Okay.
At the
Yeah,
end
I
of the
understand.
day, that's what taxes were. Oh, those that are stimulating the economy, let's help them out in some way. And
Gotcha.
that's how we make sure that we optimize how we use the tax code is through these write-offs and things like that. So
Yeah.
yeah, I mean, I'm telling you, as long as it's substantiated, documented, and
Hmm.
not abused, I mean, you're low risk to get audited.
To
I
get
have,
audited,
yeah,
correct.
yeah,
So you would say it'd be pretty safe to say that anytime you go, you're going to be writing something off as a business expense. So just document, take a picture of the receipt,
correct,
maybe document a video if you can,
correct.
save all receipts if possible. Those would be all safe things to do to just ensure the validity of the expense that you're going to be pushing towards the IRS, right?
Correct.
Okay. Okay.
Yeah,
Cool.
because
So, guys, there's a
that way, yeah, that way if they come, you're like, I wasn't trying to hide anything. It's literally like,
yeah.
you're not, it's not evasion. It's literally you're giving it all to them. As long as you give all that you're doing, how can they punish you for
Yeah,
that? You know
exactly.
what I mean?
Okay, I got it. So there's a lot of things that we could deduct that I would say the average person doesn't realize they just take the standard deduction and run. But,
Hmm.
as traders, we have a lot of things that, aren't cheap. If you're
Yeah.
paying for, our group, $50, then you've got, let's say you've got Unusual Whales. It's like, I think that's 30 to $50. Then you've got Trade the News, which I believe is like 80 to 120. Walter Bloomberg terminal is very expensive. You could have education things that are subscription based or one time, very expensive. So like these are all things that add up.
Yeah,
That can help
definitely.
easily get you above, and it also incentivizes you to spend some of the money you make on
Exactly.
a new computer, right? Because
Yeah,
a new, faster
reinvest into
computer will
yourself.
help you.
Yeah.
Exactly.
Yep.
It's not a toy at that point. It's a necessity to
Yep.
help better, what you're doing, to make more money ultimately, right?
Correct.
So
Correct.
cool, man. I'm glad. And guys, if you have any more questions about things in specific that you might want to write off, at the end of this, we'll plug Deion, all of Deion's information. We'll give his Discord name too.
Yeah.
So you guys have full access to him, because he is a wolf. And, you guys can ask him specifically. If you guys want him to do your taxes specifically, you could have a conversation with him. But right now, this is all just to provide just the general info to you. So now we talk about how we could try to deduct the active income, right? Or just the short-term capital gains. We want to see how we can minimize the amount of getting taxed at the highest rate, right?
Yeah, exactly.
So not only do we have expense deductions, but we have investable deductions, right?
Yeah, exactly. So
okay, so talk us through what are some of the things that we can invest in?
So this is for kind of our back to our active versus passive, investors, things like that. Okay, those ones that are more passive that have a W-2, they're probably more leaning more towards the 401k, depending, that might be what their W-2 job already offers. So they already put money into the 401k. That doesn't keep you away from, having a Roth. I like the Roth just because I think a lot of wolves, we plan to have more wealth, in years to come.
Later.
Yeah, exactly.
Mhm.
So the difference that you'll see with the 401k is, you put that money into the 401k and it doesn't get taxed. So it's pre-tax dollars. And you're able to put more into that 401k. They allow
A
more
lot of time
contribution.
companies, they'll match you too, right?
They'll match it. So yeah,
Uh-huh.
the 401k is more for the W-2 worker, someone that has an employer that's backing that and now help it grow. But
Gotcha.
do remember that, when it's time when it is time to take out that 401k money, they're gonna hit you with whatever
They're gonna
tax.
come and get those taxes.
So if you're in that
Okay.
highest tax bracket, and it comes in as ordinary income too, so it's gonna hit you wherever you are. Say you're richer at that time, you got more wealth at that time. You're
Yeah.
gonna get hit, with a higher tax bracket versus
Definitely.
the Roth. When it's time to take it out, you could take it out whenever, tax free, and have more flexibility with that, and have so that's kind of the differences. Yeah, you'll see here,
Yep.
the differences, the big differences. So you'll see.
So basically the 401k is pre-tax, and typically it's
Pre-tax.
more W-2 employees, and they'll match you a little bit. But when you decide to pull and actually retire, they're going to come after and get those
They're
tax
gonna
dollars
get you.
after the fact.
Exactly.
And
And it's
you're only allowed to
ordinary
give.
income too. It's not like, how we were talking, oh, long term, we want to put it in that long term capital gain. Like, okay, say you were in that 24% mark and now you're at the top at the 30%. That's a big difference.
That's 13%. That's a lot.
That's a big difference that you're gonna have to take a hit on. So it's like, do I want to do that and wait? Do I still have to wait till I'm 59? Like, I have to wait this time to take it out too. It's not like you could just put it in and then take it out. So it sits there. It is much less flexibility there.
Okay. Then the Roth IRA, and usually you can only max out every year on the 401k. I think it's 19,500. It was 18 for a while.
Yeah.
When I remember being in that corporate world. So now you have 19. But let's talk about which, guys, I would say, and I think Deion would agree, to have both. If you do work for an employer, to have a 401k, and also get yourself a nice Roth IRA as well. And the Roth I like because, like you said, it's post-tax dollars that are going in. So when you actually take it out, so for example, Dion, like let's say I've got a Roth IRA, right? And so I can only put in 6 grand for the year.
Mm-hmm.
Okay. So I take that 6 grand this year. I take it from 6 grand to 1 million.
Yeah.
Let's say I just short the wholly out of the market and we have a crash and I just 6 grand to 1 million. Insane year.
Yeah.
So I have to wait until I'm 59 and a half to start deducting that money, correct?
Yeah.
Without a penalty.
Wait, with the IRA?
With the Roth, yeah.
With the Roth, no. So with the Roth, you could withdraw. There's a small penalty. I think it's like a 10% penalty, but it's not. Yeah, it's not crazy.
But if you wait until you're 59 and a half, like it's designed, as a retirement account, because you think you would retire then, right?
Yeah. I mean, you could withdraw at any time really with the Roth. The 401k is where it's gonna it's concrete.
There's no gimme, there's no wiggle room there.
Exactly.
Okay, got you. Okay.
Yeah.
So let's say for example, we'll use the same example. I went 6,000 to $1 million, and I waited, and I just let that. Let's say I invested all of that stuff, that $1 million for the next 30 years until I turned 59 and a half, right? For example, let's say it turned to $10 million.
Yeah.
So at 10 mil or at 59 and a half, I go, all right, I'm retired fully. I'm gonna start deducting out of my Roth IRA at 59 and a half. So I don't have to pay the 10%, because let's say 10% that's $1 million on 10 million.
Yeah.
So I'm gonna wait. So now I turn 59 and a half. I start deducting that money out. That's tax-free, right?
Tax-free, yeah. It's
all tax-free.
Tax-free, yeah. Tax-free
is the way to be, baby.
Yeah. With withdrawing, having the control over what you're going to be taxed on, and that gives you more control, because like you said, you could decide how you want to invest that money, make that money, and then when it's time, like, you're in control of it. The 401k, you're just throwing it in there. Yeah, it's tax-free when it comes in, but yeah, if you do make a uber amount, you don't want to get hit with 50% damn near on the back end. You know what I mean?
Yeah.
So
I hear you.
Yeah, I always in tax, you always want to put yourself in position where you could control the narrative of what's going to go on, kind of.
Gotcha.
Okay. Yeah, before they do. That's what a big thing about the W-2 versus like a 1099 is. The difference is they're going to pay you, they're going to take your taxes, and you get whatever's left over, versus you're on the entrepreneurial side. You make your money, you deduct it, and then you get taxed on whatever else is left over. You know what I mean? So you have the control to determine what the IRS takes from the.
Yeah. Would you suggest to have both if you can?
If you can, yeah. I don't. Yeah, I think the Roth makes. I think the Roth never doesn't make sense, especially.
I agree.
I mean, unless you're, depending on your age, like if you're already almost there, yeah, I guess it won't be. It doesn't make sense not to, you're not far from that 59 and a half. Then okay, it doesn't make sense. If you're younger though, you have some time. Have that Roth, because you never know what's gonna happen, where you're gonna be. It's a account that you could depend on a cloudy day that you get. You never know.
Yeah.
That's what it comes down to too. So definitely having both.
No, good.
Yeah,
that's a good explanation. So I appreciate you going through that and giving both the sides here. So now we'll shift and talk a little bit more about some other investable deductions outside of those two. So we got the 403B. Talk to me. Who's that more specific to?
So this is for more your public school teachers, people that are in more tax exempt jobs, things like that. It's essentially a 401k. I just wanted to note it here, so people do know that there is. I think the only difference between the 401k and the 403b is there's a discrimination. I could go deeper into it, but it's essentially a 401k for your tax exempt public school.
But you have to be usually it's a government employee Yeah, okay.
Exactly. So I just wanted to open that up. I didn't know who we had in here, but just let them know that it might be more advantageous, might not.
Yeah.
Um,
We've got a teacher in here, maybe
okay.
a couple teachers. We might have some government employees as
Yeah.
well.
Yeah.
We've got a melting pot of careers in here.
Yeah.
Yeah, definitely. And then the second one being the 529 plan,
So yeah, if
correct?
you have so if you have you know a child that someone is able you have a child that you want to start contributing to a college savings or something like that, that's what your
Hmm.
529 is for.
Yeah, okay.
So after that income comes in, before you get taxed, you could put it's 15,000 in 2021. It's going to be 16,000 this year.
Wow.
So that's the gift amount though. That's considered a gift. So that's a gift amount. You get that, and that's deducted as a itemized deduction.
Wow. So you can have um it's almost seen as like they're the same thing, having a gift. You're almost like you're gifting your future children or current children,
Exactly.
right? Is that what
Exactly.
that sounds like?
Exactly.
Okay.
It's just it's like okay, it's like if it's like oh I'm gonna put it's like okay the you could put it into a bank fund just like another savings,
Hmm.
right?
Yeah, yeah, yeah.
You could put it in a saving, but it is not gonna be recognized as a deduction. So
Got
when
you.
it's a basically a 529 account that they have that the IRS is gonna kind of hold for you, saying,
Hmm.
"Oh, this is where you are contributing to."
Got
And
you.
and then I see a question really quick. I can hit real quick. It's can you have multiple 529 plans? So yeah. So I mean, it depends on how they're so like one from mom, one from dad. It depends on how. Yeah. So usually when if you file your taxes married jointly, I think they allow you to have 30,000 in gifts. So yeah, I mean you could
Got
contribute.
you.
It's gonna be it's from the tax return standpoint. So the tax it basically allows you to take the 30,000. Um,
Okay.
it is it's the same bucket for that child, but yeah, the tax return is going to be deducted by double the amount because they're on the same
That's
tax
huge.
return.
So
Yeah.
now if we threw all of this investable deductions into one pot, to say, let's say you have a W-2 job, you also trade, so you have other investments coming in. So let's say you have an employer that allows you to put in 19,000, uh, I think, what was it, 9,600? Was that what it was?
519,500
So now you got
2021.
19,500. You can also um, put in, and are you able to deduct the 6,000 that you put into your Roth?
Yeah.
And now you can deduct 16,000 per child. Well, okay, let's
Well, it
do
will be
this year,
well
50.
no. So the Roth won't get deducted though, right? Because
Oh, the Roth is that's
it's
right, that's right.
post. Yeah. So that's different though. Yeah. So
So
but
I could do the 401k, and now I could do the 529, correct?
correct.
At
Correct.
50, at 16. So now we're over 30,000 deductible investments, correct?
Correct.
That's huge. I mean, that's
Yeah.
huge.
Yeah, definitely. It is. It's big. I
Yeah.
mean, because assuming that we're getting, a huge chunk of money that we're trying to get eventually, yeah, that's you can make as many gifts as you want to separate people.
Yeah.
Like to one person, the max amount is that 15,000. But say you have
Gotcha.
5 kids, you put it into 5 different kids, or it doesn't even have to be your kid. It could be someone else. And yeah. So you could give it to different different kids. And I think
Okay.
what are
And you
these
can
questions?
deduct it.
Yeah,
So you can deduct all. So wow. So it would make
correct,
sense if you're making a lot of money to be putting away, saving for your kids for the future,
correct,
right? And putting towards investments because you'll be able to deduct that, right? The
correct.
whole goal here is to deduct off the short-term capital gains or active income, make that as low as possible.
Minimize that, yeah.
Minimize. Yeah, yeah, yeah. Okay,
So yeah,
cool.
and then Cheryl's right in this. I'm briefly reading over this. Yeah, you have to have income coming in for the Roth.
Okay.
Yeah,
Is there
yeah,
an age
that's
limit when
about
the
right.
child can use the money?
It's
Is it like
it's
18 or something?
it's designated for, yeah, yeah, usually like I think it's 18 is the limit that you're able to use it.
Because it's more for their education,
Yeah,
right?
it's an education plan. Yeah,
Gotcha. So
yeah.
going to school, all that kind of stuff. So that's pretty cool. So okay. So the child for the Roth, you got that question. You
Hmm.
said they have to have income to have a Roth, correct?
Yeah.
Okay. Okay, sweet. Um, cool. Thank you, Cheryl. Thank you, Dylan. Dylan's actually our teacher. He's one of the
Oh,
teachers that came to mind.
oh,
Yeah,
nice.
and he crushes it too. So
Hell yeah.
I got a feeling Dylan will not be a teacher for long if he keeps up
I mean,
on the
yeah,
path.
yeah, yeah. Well, he has options, is right. That's what we're giving
Yeah,
him. Yeah, let it.
yeah. He's got an option. He's got an option. Cool. So with that being said, so you guys, you've got 16,000 for the 529. Now, and then you've got 19,500. So all together, right? We're in at what, 34.5? Is that
30,
what that is?
yeah, about that. Yeah. Well, if you use the
15 for
15,000,
this
yeah,
year.
yeah, yeah.
Yeah. So we're
34,
at
5.
33, what did I say, 19, 34.5,
Yep.
33.5, whatever. Um, I mean, that's a lot of money. Let's say you make 100,000 and I mean, you just decreased your taxable income by 30%.
Yeah, and
I mean,
that's exactly for those that have the W-2 as well
yeah.
as making money from
And
the
then the
side.
trading
They
income.
have to
Yeah,
figure out, oh, this standard deduction is not enough for me. Like,
exactly.
let me make the deductions for myself, right?
Hmm. No,
Yeah,
no, no. Good. Well said. Well said. And then we'll transition into the next thing, which I think is super important. And it's what Dion is now very much focused on in his career and where he's been led to. And I would say it's the biggest tax wealth hack of them all. It's the real estate market, man.
yeah,
Um, hey, talk to me about what the fuck, and excuse my language, but not really, is going on right now with the real estate. I mean, it seems like you can sell a pile of dog shit in a shack for
yeah.
thousands and thousands of dollars
Seriously,
over what it's worth. I mean, dude,
yeah,
what happened with
yeah,
COVID? We were in a pandemic, people on unemployment, rates super low, housing prices exploded. I mean, what's going on? What are you seeing
yeah.
right
It
now?
was it was a little like I think even economists can't really put a absolute pinpoint on what's going on, but
Yeah.
really, during the COVID market, we saw pretty much a standstill on sales, but I mean, it was few sales. A lot of the sales that were happening were forced sales, maybe because the pandemic, whatever situation they were, people were selling for a reason. And
Hmm.
then as it lightened up, and we're still in the pandemic, but as it kind of lightened up, and interest rates continued to fall, man,
Yeah.
it became a complete seller's market. So
Yeah.
yeah, yeah,
The
prices.
demand, meaning when he says a seller's market, it means demand so much outweighs the actual supply
Yeah,
of the homes that if you were to sell, you would have multiple buyers bidding up the price of your home because think about it like eBay, right? Like they're just going to put these bids in because you've got a a good that is in scarcity. There's not
yeah,
that many of them.
exactly.
And couple it with you said the interest rates. I thought that was very, very interesting. When interest rates are super low, a lot of people like to lock in their interest rate if it's a fixed 30-year, 15-year at a lower rate, correct?
Yeah,
Because you'll be paying less in interest over the time. And it's funny because would you agree that interest rates and housing prices, they kind of work as inverses. A lot of times when you see a big fall off in interest rates, you'll see an increase in price of homes and
yeah,
vice versa, right?
yeah. Because yeah, it opens up to another group of buyers, right? Because
No. Hmm.
they're more inclined to get financing because they see the interest rates are low.
Are
So
low.
they're
Yep.
at that point they're more inclined to look for houses, put out offers, and you
Yeah.
still have the wealthy cash buyers, cash heavy buyers. So it's a
Hmm.
it's a turmoil of everyone. Usually
Yeah.
it's competitive, depending on where you're at in the
It's like throwing a
spectrum.
match on gasoline, pretty much.
Exactly. So yeah, everything is just going. It's not just
Uh-huh.
one specific type of property, but yeah, we're seeing just an influx of increase in sales everywhere. And that's really, I think, from, the interest rates. And I know you talk about the 10-year treasury, that ties exactly to it, to the interest rates and things like
Yep.
that. And then
Yep.
inflation as well.
It's
We're
got, I
seeing
mean,
inflation.
7%.
We're seeing
Yeah.
inflation. So a lot of people with these cash heavy people are like, I don't want this cash right now. like,
Yeah.
like,
You
let
don't
me
want
put
that.
this in somewhere else. Like this cash, I have too much of it. Like that's what I'm saying in this luxury market is like people are like, let me deploy this cash. Like right now, I need it. I need to get like it's not worth as much, right? It's not giving me the return that I want, like how it was.
Yeah.
So, or
Yeah.
able
Yeah.
to
Yeah.
purchase, the purchase power is not the same. So let me put
Yeah.
it in some real estate at the time, and let's see what it
Definitely.
goes. And that's what I'm saying. A lot
That's what
some
you're
of the
seeing.
clients that I'm working with are there. So yeah, the
Definitely.
the, the real estate market, I want to encourage people to stay on top of it, so they're planning, we're investing, making crazy gains. Eventually, we want to throw it into something where it could be like how we're going to go into a tax shelter. We went over tax deductions, but long-term wealth, you're talking about taxes on millions. It could be, uh,
Millions, hundreds of millions. Yeah.
hundreds of
And
exactly.
and they're in a long-term capital. Like let's say, for example, you have a lot of investment properties and they're
Mhm.
producing thousands and thousands of dollars passively. After a year of owning all those properties, now you shift over to the long-term cap. So now the max you'll get taxed is 20% no matter what. So if you've got, let's say you're doing 1 million in passive income from all of the rental income coming in, right? I mean, you're only taking a 20% hit,
Yeah.
right?
Oh yeah.
And don't
If
you
you do
you
it,
get to
yeah.
deduct some things off that
Correct.
passive income tax too. So
Correct.
you could bring it even lower.
Correct. Correct.
That's the life hack, you
That
know.
is. Yeah.
I'll have one question before we move to the shelter portion
Yeah.
is would you, just given your full expertise in this industry, and we've had some conversations on this.
Mhm.
The Fed has talked about having some rate hikes this year. And so when the Fed talks about doing Fed funds rate hikes, ultimately it creates higher rates for banks at what they can loan money out. And a lot
Yeah.
of times the biggest loans that they give out typically are going to be, or the most accessible for the common person would be a mortgage loan.
Yeah.
What would you think could happen possibly with this market if the Fed actually raises the rates 4 times before 2023, meaning we could see a raise in these 30-year 15-year notes? What do
Yeah.
you think in the overall market could potentially happen?
I mean, I don't see, just by the amount of supply on the market. I Even if the mortgage rates do spike, unless they spike at a, tremendously like double, it goes crazy, something that's
Yeah,
not
yeah, yeah.
expected. I still believe, like, I mean, for clients, it's hard to find regular end user houses, so I don't see that changing. Within at least a year.
Yeah.
Maybe we'll see how it goes, but that's, and I'm talking about more of the, I'm in my market. Everybody's market differs a little bit, but what
Yeah,
I'm
definitely.
experiencing, uh,
Mhm.
I don't see anyone. I mean, unless the taxes really, there's some change in tax rules going
Yeah.
forward or something, where it's going
Yeah,
to discourage people from buying. Um, I still think that, it's still going to be a hot market, and you're still going to see
definitely. Do you think there would
prices
be
go
more of
up.
an entry for some buying opportunity for lower home prices with rates increasing, that
Correct.
that inverse working? Do you think we could
Exactly.
see a cool off and a potential buying opportunity,
I think it's,
which would then still have more buyers stepping in and still create, I mean, more demand ultimately, right?
yeah, it will. Exactly. That's the crazy part. Is
Hmm.
it inversely brings you the same result, kind of. That, I mean,
Yeah.
there's no way around it really at that point. So to be honest, I would say from what I'm seeing, I don't see any
Not a market
crazy
crash, but
crash. Exactly.
maybe
Maybe a
a
cool
dip
off.
buy.
Yeah. Maybe
Yeah, a dip buying opportunity.
exactly. Exactly. I would say that there's a definite. I mean, at this rate, yeah, I feel like it has to cool off. Not where people are going underwater though,
Yeah, like,
necessarily. But
the only
yeah,
thing I would say I'm scared about is, first time home buyers was up
exact.
12% in a pandemic with the highest unemployment we've had, people getting money from the government. So, typically on those FAH loans, to first time home buyer loans, right?
The FHAs, yeah,
Those are going to be some rates as low as 3.5%. So what
yeah,
that means, guys, and Dion can, probably elaborate on this, is you only have to put 3.5% down. So let's say it's $100,000 house, you have to put 3,500 down. Now, if the price of your home decreases right after you buy this home by more than 3.5% or more than $3,500, let's say it becomes not worth $90,000.
you're underwater.
Well, you're underwater. Yeah,
Yeah,
you're underwater, right? Meaning you have negative, you don't own any equity in your home.
yeah, exactly.
You know what I mean?
The
So
bank owns your home. Yeah.
that is one thing I am a little worried about with seeing this
You
mass
can't
spike in
over leverage
inflation.
in this market.
Yeah,
No, this is
yeah.
not a market that, so that's why I'm saying when you do have some cash, I think it's still good to go into real estate. I'm not saying
No, yeah.
it's always a good option, like I
Hmm.
don't think you should base, if you're gonna go in, off all solely off, because you could be waiting for years, and then who knows what changes in life, whatever it may
Hmm.
be. So
Gotcha.
if you have an in into it, I think you pull the trigger.
For sure.
And like you said, you do it smartly though. You don't over leverage. You don't put it all. Not in this market where it's the highest it's been. Basically, you know what I mean.
Hmm. Yeah, yeah, yeah.
So it's moving smartly, and that's like up to whoever's consulting you in your real
Hmm.
estate purchase. Make sure that you're comfortable making the deal and
Yeah.
understanding where the market can go or not.
Yeah, yeah. Guys, Dion consults me, and consults some people in our network. So these are conversations we've obviously had immensely. So, we've talked about this a lot.
Mhm.
So it sounds like you're like, whoa, God, Chris, let him fucking speak. You're just giving all the information. It's like, well, he's told me all this information. So
Yeah,
just
yeah,
to give that FYI to you guys.
yeah.
But yeah, let's shift, dude. Let's go to how we can have real estate help on the deduction and the shelter side, like we said, by owning just real estate. Dion, go ahead.
So the shelter, this knowing, we went over deductions. Now,
Hmm.
real estate is really your tax shelter. That's where basically you take your wealth that you've grown, you've amplified whatever way it is, and
Yep.
you throw it into your real estate igloo basically and let it sit, right? And let it just cook. Right? Let it cook over there. And
Yeah.
and the
Your
IRS
money
can't,
tree.
yeah, exactly. And the IRS cannot touch it, depending
Yep.
if you do it right.
Hmm.
So the tax shelter, the biggest tax shelter, basically the name of the game in investing in real estate is a 1031 exchange. And that's
Okay.
going to be where, say you buy an investment property,
Hmm.
you're renting it out for 2 years. That's the usual requirement.
Okay.
Say you buy one for 500,000, right?
Hmm.
um 5 years, 10 years, 5 years, whatever it's later, it appreciates to $1 million. If
Yep.
you wanted to sell that at $1 million, you would pay, whatever your long-term capital gain rate on that $500,000 capital gain for it moving from 500 to $1 million. The 1031 exchange for wealth, this is more for generational wealth. You if you take that same property upon the sale, you use a 1031 exchange where it gives you 180 days to find another investment property that may make you more money in the long run. So say you owned a single family home, that single family home appreciated to $1 million. You're like, oh, let me try to find something else. Let me try to find something else that might bring in more cash flow, a duplex, something of the sort at $1 million. Let me turn it over to that $1 million. That allows you to bring in more income rent wise, as
Hmm.
well as avoiding these taxes because you're still in the real estate world. You're providing housing for other people. That's the tax code is like if you're upbringing basically the nation in some way, stimulating economy, providing
Yeah.
houses, doing things. That's what the tax code is meant for. So as long as we're in that line, we have a way to avoid these taxes. So like that's what I really preach is okay. That's why I want you to get into this real estate because okay, you could take these deductions all the time, but let's have some money sitting like
Hmm.
for when if you have kids, whatever it is, because if it's that time and you go away, then your kids get that property at the basis at the death you die at the day you died. So they're not going to pay any taxes if you keep it, and it's still within your family. So
Yep.
I just want to like let people know let's have a plan with our wealth. Okay, let's make money, amplify our wealth now, and then figure out where we could do to make this generational wealth. Right now, we're creating
Yeah.
wealth, right now for ourselves. Let's keep it going for years and years. And
You
the
got it.
1031 exchanges, all
That's
what these clients,
that's the life hack
yeah,
of
yeah,
real estate is
yeah,
1031.
yeah,
So what you're saying is, uh, let's say Susie Q. We'll give an example.
mhm,
Buy a home up in the Hollywood Hills or like in Corona del Mar, like
yeah,
back in the
yeah,
70s, 80s, right? Or homes were 100,000, 200,000. Now that home, let's say it's 200,000. Now that home is worth 2 million.
mhm,
So it's appreciated 10x, right?
mhm,
So as long as they lived in it, longer than 2 years, you said,
yeah,
let's say they've been living in it for 30, 40 years. And now it's time for them to sell because they just want something smaller, whatever the reason might be. So they would have $1.8 million in profits or capital gains. Now it
yeah,
would be long-term capital gains. So you would get taxed at 20%. But 20% of 1.8 is still $360,000. I
yeah,
mean, that's no sweat off nobody's nose, right?
yeah,
So what you're saying is the 1031 exchange is what Susie Q could do is take and put into the 1031 exchange and go invest $1.8 million in another home, other investment properties, and have zero taxes on it. That's what you're saying.
yeah. So what she would probably do, how she would strategize to do that is, yeah, you own that home
Mm-hmm.
prior prior because usually with the 1031 they want to see that you're renting it out to someone, right?
Yeah,
So
yeah.
yeah, let her go live somewhere else and live off that rental income 2 years. You know what I mean? Like so you this is what I strategize. Sometimes I ask, are you ready to sell your home? Are you sure? Do you know the capital gains? All right, how about we do this? You rent out something, even if it's down the street, rent out a house down the street.
Yeah.
Rent yours out, pay for the house that you're renting out and living in through that rental income. So the
Yeah.
IRS sees, oh, this is getting rented out. Okay, when it's a time to sell, now you could run that. Now you could go buy another one, another use that 1.8, the 2 million, the whole 2 million.
Yeah. The whole
Buy
2 million. Yep.
yeah, buy multiple properties if you had to.
Yeah.
And then a little hack that I tell them is then you could there's options like cash out refi. You could take out money. What are they going to say? You could take out money for whatever reason you want. Like, and
To
it's not
for
going to
like a
be taxed.
payday, like a
Yeah,
payday.
it's not going to be taxed, and you
Mhm.
could use it from there. Yeah, your debt is going to heighten by whatever amount that you take out, but
Yeah.
assuming it's free and clear, it's not that much, right? Compared to
Assuming you
what you're making.
invest,
Yeah,
yeah, you invest enough money in homes that people pay rent to you,
yeah.
and now it'll basically pay back your loan
Yeah,
plus some,
yeah, you could reinvest that refi. So it just
or
gives you
reinvest. Yeah.
options. Yeah, it gives you options. And knowing that it's just like putting you in control.
Okay. Gotcha.
Yeah,
Hold on
yeah.
one
So the
sec.
1031 is putting you in control. And
Gotcha.
yeah, and that's and yeah, so that's the 1031 for you. And then the
Tell me
section
about the section 121.
Yeah, that section 121, this is outside the investment world. This is just something I want to highlight for those that may already have a home or primary residence and not
Mhm.
know maybe that you could time the sale of your home a little bit better depending on how it appreciates. This section 121 exclusion, it
Mhm.
allows for you on your primary residence, that's the residence that you live in day to day.
Gotcha.
So for someone that's single, that's filing as single, it allows you. So if your house appreciates up to 250,000, it excludes that appreciation. And you won't have to pay any taxes on the appreciation. And if you're filing married jointly, you get 500,000. So
Oh,
that's
wow.
just something to keep in the back of your mind, you know, to try to, it's still a
Wow.
tax shelter, not as big as a 1031, but
Uh-huh.
it's still
But let's say it's for the more of like the everyday,
exactly.
the non-investor. Yeah.
Yeah, because
Okay.
you know, sometimes for people, I mean, the house is the biggest purchase that they're gonna make, right? So it's like,
Mhm.
okay, it's gonna appreciate if you have an appreciating asset, you still have to manage it, right? So
Correct.
okay, maybe oh, that 250,000 appreciation mark just passed. Maybe you could think about selling and then you restart, you know, and then if it makes sense. So it's just understanding the code and
Yeah.
taking advantage of it to
Yeah.
pertain to your lifestyle. And that's all I'm
Definitely.
trying to, you
For
know,
sure.
implement and help people out. And, you know, it
Yeah.
depends situation. It's a situational thing, but I think everyone could benefit
Definitely.
with a little bit more knowledge. And that's why we're here, bro.
Yeah, no. So to give an example of the section 121, let's say me, single, filing single. I bought a home, back in 2010, right,
Hmm.
and it was worth 100,000. And now today, 10 years later, it's worth 300,000,
Hmm.
right? No, or you know what? It's worth 500,000.
Yeah.
Okay,
So you got
and I
400.
want to sell, and I've been living there. It wasn't an investment property. I was living there. So now I've gone from 100 to 500. So I have 400,000 in capital gains. Um, and I lived there longer than 2 years, obviously. So now I would be able to deduct 250,000
Yeah.
off the taxes, right?
Yeah.
So that would mean 400,000 minus 250. So I have 150,000 now,
In capital.
which
Yeah.
I would have to pay long-term capital gains on, correct? Which
Correct.
is 20%. So
20.
I just
Yeah.
went from having to pay 20% on 400,000
Yep.
to now 20% on 150,000.
Yeah. Correct.
So I
Correct.
went from what, 80,000 to 30,000.
Yeah. And that's
And
depending on where you're
that
at on that. That's
50,000
a
could be a down payment somewhere else,
yeah,
right?
exact, and that's what
Yeah.
we have to put that. Even if you threw it in, staked it in somewhere in the stock,
Or put it in the stock market, or
yeah,
or went and bought some crypto staking,
yeah,
or bought a dividend portfolio, or maxed out your Roth, or
yeah,
all that kind of stuff,
yeah.
right?
No, that's how we
Yeah.
have to think, though. Like constantly reinvesting this tax money we're saving, right? Because if we're not, we're that's going to allow more ways for us to keep using the tax code to our advantage. When you keep
Definitely.
reinvesting in things that the government kind of entices you to use that not
Yeah.
everyone is, you know, and
Yeah.
the wolves are, that's what I think part of this community is. Everyone is interested in figuring out every way they could
And how,
obtain
yep.
their goal of wealth. And you know,
Yep.
this is just another avenue of how you could get there quicker.
Hmm.
Yeah.
No, definitely. No, that was good.
Yeah.
That was good. That's why we always want to just plan, right? We always
Exactly.
just want to
Yeah,
plan for
like
the
you
future.
say, plan the trade, trade the plan. That's this. That's like that's
Yeah.
seriously, yeah,
No,
seriously.
I mean, plan the trade, trade the plan.
Yeah.
And plan the investment, invest the plan, baby.
Invest. Yeah, for real.
I mean, you can do that with anything in life,
Yeah.
really.
Yeah. Yeah.
So
Yeah.
yeah,
Yeah.
that's good. So hopefully you guys understand where, when you're talking about rich people, then you're talking about those that are generationally wealthy or just wealthy in general.
Yeah.
This code was made for us to utilize. Now
Yeah.
the information hasn't been readily available, but it's there, guys.
It's
It's
there.
definitely there. I hope this call, definitely helped. The Dion keeps making a point where he's talking about the tax code is made to help those that stimulate the economy. And what he means by is this, guys. The government is not a company. Okay.
Yeah.
They're not for profit.
Yeah.
Okay. They're not stimulating the economy. So what they're doing is incentivizing entrepreneurs. They're incentivizing capitalism. They're incentivizing people that can stimulate the economy by creating businesses, creating services where people go and spend money. When money is circulating, the economy is stimulated.
Yeah.
When it is not circulating, it is stagnating, right? And
Yeah.
there's actually will be a contraction. So they want to ultimately keep this wheel spinning. So they incentivize you to go out and start businesses, create streams, all this kind of stuff, right?
Yeah.
Investment income. So just something to think about. I know, Deion keeps talking about it. I wanted to just break it down just a little bit
Yeah.
further so you guys can understand.
Increasing the velocity, it's the velocity of money, and that's what the government wants. That means basically the time that a dollar is being spent, that means taxes are going to be paid, and the more that's happening, more taxes are coming through. That they think like that's kind of the logic, unless you use the tax code to your advantage. So that's the difference. You could be on both sides.
Yep.
It's your choice.
Yep. Well, guys, really, that's really what we had for today.
Yeah.
And I know we gave a ton of info. We're gonna give Deion's info out.
Yeah.
I want to say thank you, Deion, for taking the time, guys. He
No
did this for
problem.
free. He approached me,
Yeah.
and approached Justin and I, and wanted to do this for the team.
Yeah.
I think there was a couple questions. If you got some time,
Let
man,
me
if we
see.
can
Yeah,
just,
let's see.
if we
I
go up
think
here.
Dylan left. I wish he was there, but let me see what he was saying.
So I think Tish,
Tish, there we go.
She had a good
Yeah.
question. That, hold on one second, guys. 1 second.
You're doing it every day. Have a second thought. So okay, what if we are making more trading than your day job, and you can prove you're doing it every day and have a second job? That's gonna, just like we said, so the IRS definitively calls anything that you do less than 750 hours a passive activity. So it's not always based on monetary, right? Because yeah, I mean, if someone puts, even if somebody put a million into your investment account, and you were getting the money from there, that's not technically what you're doing. So it'd still be passive. So with that like the mark to market, you have to substantiate that you're doing this. Let me see if I have the exact requirements needed. Let me see real quick. I think I noted. So it's like saying, they're saying, we recommend an average of 4 trades per day, 4 days per week, 16 trades per week. So about 60 a month.
Okay. So that's what?
So about 720, it's saying 700 total trades per year as the volume.
Yep.
And then it says executes trades on close to 4 days per week. So about 75, a little bit over 75%, 80% of, the available trading days.
Yeah.
And then the biggest thing is the holding period. It says the IRS says you have to have an average holding period of 20 days or less. So, if you have that, I guess if you meet all those requirements, yeah, you could make this mark to market.
So what you're saying is she could coincide, like she could coincide her active income, and basically have dual income.
Yeah. I mean, the tax return, you can have, people have income from everywhere. Like you got to think, people, like whatever they're doing, you have a job, and you have, like, an athlete or something might make more money off getting advertisements and things like that than they make through their actual money. So it's the same type of thing. You could have multiple streams of income, and just because you make more in another stream doesn't make it your line of business. It's just, they don't discriminate with the income. They're gonna tax you on it regardless. So it's really how you control it, and how you use the deductions and whatever you can to do it.
Yeah. So as long as she meets the requirements, you wouldn't see why there'd be.
She can make that mark to market
account
election,
or
and then
election. Yeah.
Yeah, and then so that would change her. Then she could instead of using the standard deduction, um, itemize her deduction. But again, like sometimes it might be better to use the standard deduction if you aren't making you don't have the expenses to
Yeah,
surpass
or if
what
your
the
expenses
standard.
don't outweigh
Yeah, exactly.
12,500 for the year.
Exactly. So
Okay.
so it's not based on, what's your primary job. It's based on having all that income and figuring out the way to deduct that amount.
Deduct it.
Yeah,
Yeah.
exactly.
Yep.
Exactly.
Okay. So hopefully,
Mhm.
Tish, that makes sense a little bit. It's more on the expense side for the deduction purposes. So if every year from trading you're having to spend that more than the standard deduction that you normally would, then it then definitely would make sense. It sounds like.
Yeah.
Um, Dylan asks, "Is it worth picking up your real estate license?" I mean, Deion, you answer this, but my answer would be, of course.
I mean,
Um,
if you want, it depends on how much you want to be involved in it. If you are, I mean, is if you want to use the time to get, if you just want to be an investor, I mean, it's not necessary. Um, but I would say it would help you. You could broker your own deals if you're
yeah, that you would save on commission fees,
yeah,
right?
yeah. On one side, yeah, you would save on commissions. On one
Unless you
side.
buy and sell the property to yourself.
Exactly. So I mean, it's like it depends on how much volume you're doing in the market. If you're active and yeah, then yeah, you'll probably it'll be worth it for you to get your real estate license. But I don't
Yeah,
I don't think it's necessary.
not necessary.
Yeah,
No,
yeah.
but it's definitely good. Some people could flip homes too. If you have your
Mhm.
own license, you can buy.
Exactly. That's
Yeah,
what that's what people do. Yeah, like because that's some
mhm.
more volume, right? You're like active. That's active though. You're actively looking for a
Yeah,
property. It's different than when you're. It depends on what if you're doing it passively. Yeah,
yeah,
you could look at it. You have the money ready, and then when it goes, you pull the trigger. But yeah, if you're
yep.
in the flip business, no.
No. Okay. So the next question that came in was, well, Tish says yes, thank you. That makes sense. I was trying to max that out since my property taxes are over that of 12K, so that
Mm,
would make sense.
okay.
Um, Boodstock says, can you go over the wash sale and how it applies to a full time versus part time trader? So I believe the wash sale is to both part time.
Actually, on the mark to market, and if he wants to reach out to me, personally too, he can because with the mark to market thing, the stipulation in that is whatever at the year end, they're gonna mark that as what as sold basically. So say you held you there's no basically there's no long term investment you're gonna have because there's no wash sales because at the end of the year you're that's gonna be your end of the year basis, and then on January 1st, 1/1, that's gonna be your new basis, and that's what's gonna be recognized, whatever happens within that year. So that's the
Gotcha.
difference between the mark to market. So there's no really wash sales because your basis starts over in the new year, if that makes
Gotcha.
sense. Yeah.
Thank you. He says, thanks. I will reach out. Yeah, Boone.
Okay.
We'll put the
Yeah.
information in there for you. But just to clarify the wash rule too. So the wash rule is pretty much by the IRS. It's basically talking about if you sell a security at a loss, and then you buy it back within the same 30 days, that is substantially similar to before, you won't be able to use the capital gains loss.
Yeah, exactly.
Yeah.
Yeah.
So that, but the stipulation would be is switching over to market would ultimately take that take that out. Correct. Sounds like.
Correct. Correct. Correct.
Okay. Okay. And so Boone, yeah, if you have any more questions, man, we'll get Dion's information. That goes
Yeah.
for everybody that's on the call and that ends up getting to watch it. Um, so we'll make sure we post it. We'll post his link when we upload it, but we'll put it in the group for you guys too.
Yeah.
Um, are there any more questions? Anyone have anything else they want to get in here last minute? I think we've been going
Yeah, this
about an
was
hour and
good.
30 minutes, but it was good. I thought it wasn't too long. I thought we got a lot of good information in there.
Yeah, I hope so. And I
If,
hope yeah, we could keep building off these. I want to get more
yeah,
of these and just soak it up.
no, for sure. No, for sure. Let's see. No one's typing anything. Dion, do you have anything you want to leave us with?
Man, just another thank you to you, Justin, all the wolves, anyone in here. I really appreciate you guys using your time to, better yourself. and listen,
Yeah.
you know, whatever you could do, I appreciate it. And I hope I could help, you know, in the most minimum way. That still gives me satisfaction. I really am here to just, you know, help and just let you know on any knowledge that I have that I could help you in, even by 1%.
Definitely. Well, bro, I just want to say thank you, bro, for taking the time. Thank you for reaching out to me and, you know, really putting this and making this happen. You know, obviously we got you on, but you curated the whole thing by reaching out, brother. And again, dude, you know, we've been friends for a while. I'm super happy to see the success you've been doing, bro. And you know, it's reflected you know, in your results. And I wish you the best of luck moving forward in all these markets. I
Same,
know
same.
you don't need any luck. You create your own luck with the hard work, bro. And you know, just want to say thank you again for doing this for us. Brian says we'll get him on the podcast. Yeah, Brian.
Oh yeah,
We're
no
looking to
problem.
start
Oh
a
yeah, let me
podcast.
see it.
He's
Oh
out here
yeah.
local in LA.
Oh yeah,
You know,
definitely. Let's do it. Yeah.
yeah,
Yeah,
no, for
bring me
sure.
Don
So
on. Yeah, we're gonna just go up from here, man. I'm really excited for this year in the Wolves. What we got going.
definitely 100%. And the feeling is mutual. It's all the same, brother. You have a great rest of your day, man.
Yeah,
Thank you guys for
definitely.
tapping in with us. This is not the
Thank you
last you'll
guys
see of
for real.
Dion,
This was
for real.
successful. I had a good
Yep.
time. Seriously.
Good time for sure. Hey, thanks, man. You have a good rest of your day, brother. Wolves. We'll see you guys on Tuesday. Remember, Tuesday is the next day of the market is open. Justin and I are figuring out if we're gonna do our Sunday sermon still or a Monday sermon. So we'll get back to you guys there soon. But other than that, Dion, thank you again, brother. You guys have a great rest of your day. We're out of here.
No
Peace.
problem. Peace.